Hi everyone, a very good evening. You're watching The Money Show on ET Now with me, Mubina Kapazi. This is a show where we talk about all the latest news that do affect your personal finances, your mutual fund portfolio, and of course we answer your questions and queries as well. So you can write into us on The Money Show at etnow.tv and we'll get your questions answered. So let's tell you what we have lined up today on the show. First, let's talk about the norms that have been released by SEBI, which mutual fund companies are expected to follow. Quite a few of them. The two most important ones are with respect to the dividend plan that mutual fund companies do have, and I'm sure many of you all as well, of course, have chosen one of the plans, either dividend reinvestment, dividend payout, etc. And the second is with respect to labeling mutual funds in terms of their risk, or what we often call as a riskometer. Many a times we often say that look at the risks involved with a certain investment instrument and then decide whether you would like to make an investment or not. Just to give you an example, we say equities are a bit more risky than maybe say a bank fixed deposit. Now what SEBI has said is that all these mutual fund schemes will have to be categorized into 6 risk buckets. Ranging from low to very high. Very high, in fact, is a new bucket that has been added by SEBI. So what does it mean? What does it mean for you, the investors? Is it essentially in a bit to make everything more transparent? Well, the bid is of course that, but if you, the viewer, if you've read these norms and you're finding yourself a bit more confused, well, that's exactly why we are here. And of course, our guest for today as well is here for exactly that. It's my honor to introduce Shweta Jain of Investography. She joins us now on the show. Shweta, thank you so much for joining us today on The Money Show. So to start with, let's first get an overall perspective of the norms that have been introduced by SEBI, in the last couple of days. More from a unit holder or a mutual fund investor point of view, how do these norms matter?
Hi, Mubina. Thanks for having me on the show. So the idea that SEBI has in mind is to basically increase the transparency and also understanding of the underlying securities for investors. So basically, where riskometer, which was earlier just pictorial in nature, today they've introduced one more category, and they've also introduced these scales where 1 to 12, for example, in terms of debt, where you actually have numbering and labeling, which is very, very clear. And the biggest difference, I think, in debt in the riskometer is that there are 3 categories that have been introduced. So even in credit risk funds, duration will now be considered, which was earlier not the case. In duration funds, credit risk of the portfolio will be considered, which was earlier not the case. And earlier, as a category, risk was sort of determined. Today, each scheme needs to define the risk and calculate the risk that it's taking, which gives a huge boost to transparency in terms of understanding for the investor. Because earlier, I know we would talk to clients and talk to them about credit risk funds and why a certain portfolio is different from the other when it comes to duration of that same portfolio. So that is introduced in the debt side. So there's credit risk, there's interest rate risk, and the biggest difference is that there is now a liquidity risk also added in these debt funds. Because if you see one of the factors, and I think this is drawn by the recent sort of happenings that's happened in the debt side of the mutual fund portfolios. So liquidity risk is something that earlier could be ignored, today is not something that can be ignored. So these are 3 big factors that have been taken on the debt side. The riskometer for equity is also now more clearly defined. Market capitalization, volatility, and impact cost are the 3 factors that will be considered. And these are, again, very, very pertinent to the equity side. And what they're also determined is, the score will start from 5, where debt starts from 1. So you're starting off on a very high risk scale already. So it's clearly telling investors that, the risk is high in these investment options. The attempt is to bring clarity and transparency. And I think this is a good move in that direction.
We'll delve a bit more into the risk bit, especially that bit you mentioned about debt mutual funds. Let's talk about this whole thing about renaming dividend plans. Now, ordinarily for a viewer, when he or she opts for dividend payout plan, they get on a certain frequency dividend credited to their bank account. But now SEBI believes that it's not so simple, and that dividend from an equity share is actually very different when you get compared to a dividend from an equity mutual fund. So why this renaming? What exactly is the significance of this?
This is again a move in the right direction for me, because when you get a dividend from a business or an equity share, it's profits that are being distributed from that business. But in a mutual fund, the payout is happening from the investor's capital itself, from the investor's holding itself, which is very different from profits, right? So it's from your own money that you're getting dividends back, and this is one of the reasons why this change has been made. Now, for example, dividend payout is going to be called payout of income distribution cum capital withdrawal option, which is clearly telling investors again that it is your own capital which could be withdrawn. From a fund house's side, they need to now ensure that a clear segregation between income distribution, which is the appreciation of the NAV or appreciation of the fund value, and capital distribution should be now disclosed in the consolidated account statement, so which is very clear. So this is because of certain practices where funds were sold on the basis of the promise of paying regular dividends without understanding the product's risk associated, so that is why this change has been made, that it's very clear, very clearly communicated to the investor that in this case, it is your own money that is also being part of the dividend that is coming to you, not just the appreciation bit.
When you put it that way, Shweta, that it's basically a little bit of my own capital as well coming back to me. Many a times, and especially those investors who would like some frequent money coming in, from their investments, perhaps because they are dependent on these investments, for a regular stream of income, they do opt for this dividend scheme. Sometimes they do so even when they don't really have this need, for a frequent stream of income. So, firstly, do you even recommend to investors to click on the dividend option, even if they are depending on these investments, or do you think that there are better frequent income generating investments out there?
So we don't really recommend the dividend payout option. What we recommend is the SWP option, the systematic withdrawal plan option, which is a far better way of withdrawing, even if it's part of your own capital. So you're aware that it's a part of your capital that is coming to you. And over time, as the portfolio grows, you can also tweak how much cash flow you need. See, dividend, again, you're depending on the fund house to distribute that money. So SWP enables you to design that same comfort, but in a much tax effective way, in a better way, and customized for you.
Okay, so if you are dependent on a regular stream of income of some sorts, don't click on the dividend option, rather opt for an SWP according to Shweta Jain, and I hope that's the advice that is for all of our viewers, if they do want some money from their mutual fund investments. Okay, now let's talk about this entire risk bit. It's actually pretty comprehensive because it covers equity mutual funds, debt mutual funds, even gold funds, gold ETFs rather, REITs as well. Do you think that this new category or labeling is more effective than what it was earlier? Because I remember that every scheme, every fact sheet does have a certain riskometer, and it indicates that whether it's moderately risky or moderate or low risk, so on and so forth. So for a viewer, when I have to assess the riskometer, do you think that now it's become much more easier for me to assess the risk?
It is, I think, because earlier as a category, like all credit risk funds would be painted with the same picture, right? So you would see a similar sort of risk profiling against each of these schemes against the category. But today, when you even compare credit risk funds one against the other, you will see that one could be slightly less riskier than the other based on whether it's duration, whether it's liquidity, whether it's the type of portfolio, right? So now it's giving you much more clarity, much more information right there at your fingertips. And this is going to be disclosed monthly. In fact, annually, when the reports are going to be filed, they will have to disclose how much the risks have changed over the months, even in that particular scheme as well. So there's a whole lot of information there. So now investors don't have to just depend on past track record or ratings of the fund, the star rating of the fund. They have at their disposal all of the information that they need, very clearly labeled and numbered and accurately mentioned, so they can compare apples against apples and then decide what's best for them.
So even as the months pass, between the last month and the current month, if let's say a fund has taken a bit of a risky bet, or the risk profile of the fund has increased, that as well should be communicated to the investor so that the investor knows what he or she has bought into. Shweta, that point you mentioned in the first answer on debt mutual funds, there's interest rate risk, there's credit risk. Now what debt funds have to do is assess on liquidity risk as well, and that, like you mentioned, it could be on account of the entire fiasco that we saw with one particular mutual fund house in April. So does it mean that when I'm looking at a fact sheet of a debt mutual fund, or if I look at any information on a particular debt mutual fund, it will tell me the risk for each of these categories of risk, like you mentioned, that credit risk is this much and interest rate risk is this much and liquidity risk? Is it that way, or is it an overall gist?
Ideally, you will be able to see an average risk of all these three. I'm not sure how they're going to start disclosing, but I'm sure they will have to disclose at least the average of all three. But because there is so much clarity in terms of numbering, which is sort of how much of a risk, you will be able to see individually whether the credit risk is higher or lower. Because say, for example, GSEC is one being the least risk, and say an unrated paper will be say 11, or a below investment grade paper will be 12. So you should be able to see this, but also an average that you should be able to see for the scheme. An average will be of all these three factors, right? So of liquidity, of credit, and of interest rate risk, because these are so clearly defined. You'll be able to see an average. In fact, where the liquidity risk is higher, higher than the average, you will see that the higher risk is being displayed as well. So that means the risk value of the portfolio is high, while the papers may be good, while the duration may be lesser. But if the liquidity is not there, that's going to be showcased very, very clearly to the investor.
Okay, all right. So it's definitely going to become quite easier when it comes to essentially understanding, how much risk, what kind of fund carries. Shweta, given the kind of situation we are in right now in terms of interest environment, in terms of economic situation, etc., would you advise that investors sort of choose, let's talk about debt funds, of course, because equity mutual funds, I'm sure you would also say that it's for the long term, and it's because it does tend to have a little more risk. So let's talk about debt funds, because those are the ones that sometimes can be a little tricky, especially because we invest in debt funds when we have a financial goal that we want to achieve in the next under 5 years. So do you think that given the environment that we are in right now, we should sort of not venture out too much in terms of risk profile and stay a little more on the conservative side?
Definitely. I think this is something that we've been talking about for the last few months. When there is uncertainty in the environment, it is always better to protect your capital first, which is especially in short term in nature. Also, the idea of debt is not to generate huge returns or get that extra kick of returns. The idea for having a debt portfolio is that your money is safe, is that you are able to sleep peacefully at night. So don't try and be a cowboy or a cowgirl and try and take that little extra risk when it comes to your debt portfolio. Stick to a good credit portfolio, stick to shorter durations today, so that and liquid portfolios, of course, so that you are not exposing yourself to unnecessary risk, because the whole environment is so uncertain, whether it's businesses, whether it's pay cuts, whether it's job losses. So it is something that we recommend to people, that your debt portfolio is for you to sleep peacefully at night and for your shorter term goals. So protect that first.
Okay, all right. Well, there you have it. That is, of course, the view coming in from our from Shweta Jain on, well, not just the SEBI norms and how essentially can you as a mutual fund investor understand how these norms affect you, but also, of course, how you should invest. And with these new norms that SEBI has released, it's going to become much easier as well for you to gauge the amount of risk you have taken in your portfolio with the existing mutual funds, and you will take if in case you plan to add any more mutual funds as well. Shweta, really appreciate you joining us today on ET Now and helping all our viewers out with their queries. Folks, if you would like to catch this entire episode, you can do so by logging on to ET Now's YouTube channel and find the Money Show playlist. And with that, we'll wrap it up on the show. Many thanks for watching.